Thanks for tuning in to this week's investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. All right, so we'll start this week with our chart of the week, which we just titled Bond Math. And we spend a lot of time in these presentations and in our written work on the stock market because stocks tend to be more volatile. And it's a little more challenging to try to predict where returns are going to go for the stock market. And that's particularly true because stocks tend to track corporate earnings over the long term. And it's really difficult to get a call on 5 to 10 year corporate earnings correct. But bonds are a bit of a different story because bonds very much are a mathematical equation. Since you have a coupon in which they tell you what they're going to pay you over the duration of the bond, in the absence of default, you know what to expect in your return for bonds. And that's what this chart here is showing, is it's showing the starting yield on the x-axis and then the subsequent 5 year annualized returns for high quality fixed income on the y-axis. And you can see that today the starting rate is around 4.6% on high quality bonds. And that implies that the forward expectation for returns is about 4.7%, which is not the highest that it's ever been, but clearly higher than what we saw in the 2010s and fairly respectable in terms of real expected returns, as inflation is expected to average under that 4.7% number. So looking at bonds, definitely more of a live asset that we can collect that coupon on now and expect better returns going forward. Now, looking at market action last week, the rally did start to broaden out to small caps. So international markets are still the leaders for the year. Developed international markets up 25%. Emerging international markets up a little over 20%, whereas the S&P 500 is up about 11%. So still a respectable return, but international stocks have certainly been the leadership. Up until last week, small caps had actually oscillated between a negative return on the year and just a mild positive return. But we did have a very solid week for small caps last week. And now the Russell 2000 index, which is a broad measure of small cap stocks, is up 6.8% on the year. So seeing small caps begin to participate is a good sign. And we'll touch on that a little bit later here in this presentation. So last week, from an economic data perspective, we really got the first influential data point for August economic activity. So S&P Global does a flash estimate for growth in both the manufacturing sector and the services sector. And then they do a composite of those two, which you can see in the top clip here. And you can see that really driven by a bounce back in manufacturing in August, the composite PMI did rise to a pretty robust level of 55. Anything north of 50 indicates growth from an economic perspective. So now the manufacturing PMI, the service PMI are both comfortably above the 50 level. We'll see if that continues throughout the year, but certainly a good sign that economic activity was picking up in August. Also notable from the report, which is not quite so positive, is that pricing pressures continue to rise. So, and it's very much acute here in the US, implying that tariffs really are taking a toll from an inflation perspective. So this lighter solid blue line here is the price index for the United States. And you can see that that is up near its highest level that it's been in a couple years, up above 59, whereas all the other major economies shown in this chart have a more benign inflation backdrop to them. So that is kind of the one negative that we're seeing in the PMI indices is more pricing pressure. And housing activity is mixed. That's another piece of data that we got last week. So we are seeing range-bound new housing starts, which is fine. But we've also noticed that building permits have been easing, and that tends to lead new housing starts. So if this follows through, we can expect continued headwinds in the housing market and potentially slower new housing starts going forward. And that's important because we look at construction employment as a leading indicator for the broad global or the broad employment picture here in the US. So if construction employment starts to falter, that would tend to be a leading indicator that employment more broadly in the economy is starting to ease. That said, really, you've got competing narratives here for the Fed. So economic growth is clearly okay. The PMIs show us that activity was starting to accelerate again in August. And unfortunately, the inflation picture looks a little less benign than it did at the beginning of the year. There is certainly some inflation pressure here, but you do have weakness in some areas that are interest rate sensitive in the economy, like the housing market. Jay Powell gave his speech from Jackson Hole last week, and that really did open the door to a September rate cut. He was somewhat dovish in those in his comments, and you could see it in the probability markets, where now the market is pricing in an 86% probability that the Fed is going to cut interest rates in September. So that speech really did speak to the market participants in terms of the Fed is comfortable with some form of looser monetary policy going forward. Now, a September rate cut, we spoke about this actually last week as well, could support the bull market going forward. So this chart shows the average pattern for the S&P 500 after the Fed has resumed rate cuts after pausing on their rate cuts for 6 months or more. So we had a long pause since the last rate cut. The Fed's looking to resume potentially in September. And so what has tended to happen historically is the markets tended to rally in the 3 months leading up to that next rate cut. And then again, for the next 12 months, the markets tended to perform pretty well. So a September rate cut could support the continuation of the bull market. Also supportive, I mentioned that small caps were participating last week and really joining in for the first time this year. And what we're showing here is we're showing an all cap equal weighted index in the top clip and an all cap advanced decline line in the second clip. And by all cap, that means that it's inclusive of not just large cap stocks, but mid cap stocks and small cap stocks as well. And you can see when we equally weight those, the market has just recently gotten back to all-time highs on an equal weighted basis across market caps. You can see that in the top clip. And in the bottom clip, you can see that the advanced decline line is starting to get close to all-time highs as well, which would be a solid confirmation of the bull market. And in fact, all the numbers on the bottom of this chart are telling us is that when both the price action, like you see in the top clip, and the market breadth, like you see in the second clip, are both in alignment and in uptrends, then you do tend to get some pretty strong bull market returns in the market overall. So that confirmation is helpful to give us confidence that this bull market remains sustainable. So that's what we have for this week. The chart of the week here, in the absence of a default, high quality bonds are expected to deliver just a little bit under 5% over the next 5 years, which could be attractive relative to inflation, assuming that inflation tracks where the market expects it to go over the next 5 years. Returns have been strong in 2025, and last week small caps did begin to join in on the rally, and that's a good sign as well. The flash PMI estimates for August showed that there was a bit of a growth acceleration on the month, but there's also notable price pressures, and that complicates Fed policy. Even so, Powell's speech at Jackson Hole opened the door to a probable September rate cut, and that could support the continuation of the bull market as well. And even so, one of the things that's notably positive is that price trends are currently being confirmed by market breadth trends. So that's also a good sign of bull market sustainability. As always, we want to thank you for joining us this week, and we want to wish you a terrific week ahead.